The golden rule of lending, portfolio at risk, how to protect and grow your loan portfolio. This video is sponsored by Leon Consulting. Today we'll be explaining how portfolio at risk power works in a microfinance bank. If you are a credit analyst, risk manager, or you work in a microfinance bank, this, I bet you, is a place to be. But first, hit the subscription button, turn on your notification bell so that you receive good quality content from us that keeps you ahead of your peers in the microfinance industry. But first, no story is as good as a sweet story. Listen to this introductory story about Linda and her branch. Let's get going. Meet Linda, a dedicated branch manager who works at Leon Microfinance Bank, dedicated to duty with an increasing portfolio for her branch B. She has quite a very large portfolio. This is because her branch B, has been disbursing loan at a record pace. She attends to different kind of customers, solving their problem, granting them loan, making sure that every request is being attended to. But there is one flaw. On this particular day, the bank's risk manager walked to her desk and asked her a critical question.
How much of our loan portfolio is at risk of not being repaid?
Linda was a bit confused because she didn't really understand the dynamics of portfolio management and especially portfolio at risk par. All she knows how to do well was to disburse loans. The percentage of the total loan portfolio that is overdue beyond a specific number of days is becoming an issue for our bank. PAR for Linda's branch is not just a regulatory requirement. It is the ultimate health check for our lending business. It measures portfolio quality, indicates future loan losses like defaults and reduced profitability, and help assesses the true effectiveness of our credit officers. While the industry monitors loan overdue, let's say 1 day, 30 days, 60 days, or 90 days and above, Linda's bank focus on the industry standard benchmark per 30, which means loans overdue by 30 days. That is where and what a bank branch focuses on. Chapter 2. Let's look at the math of lending. To understand a branch standing, Linda needs to run the numbers. She learned the universal formula for portfolio at risk. By the next week, they had a meeting where the bank risk manager is PAR.
Portfolio management is about balancing risk and return. We diversify assets to minimize potential losses. By actively rebalancing, we maintain our target allocation. This protects our capital.
What is PAR? PAR is the outstanding balance of loans overdue divided by the total gross loan portfolio multiplied by 100. Yes, it could be more than that. In case they have renegotiated loans, this will also be used to calculate the PAR. But today we are not going deep into that level. We are just taking it one step at a time. So what did Linda do? Linda pulled her branch record for a practical test. The current loan for our branch is 80 as of today. Loans overdue, that's loans 30 days in arrears, is up to 10 million. Loans overdue 60 days and above, that's 5 million. Our total gross loan portfolio was 95 million and our outstanding loan overdue 30 days total 15 million. She plugged the numbers into the formula that was given to her. Per 30 will give you 15 million divided by 95 million multiplied by 100. With the total of what she was having, because the figures were a little bit at random, the result was 15.79. This meant that for every 100 naira branch lent out, 15 naira 79 kobo was approximately problematic. This is terrible. This is not nice. The figures are not looking good. 10 millions over 80 million. This is terrible. Was 15.79% a good score? Linda checked the industry benchmark. Let's look at the industry benchmark. PAR level and its interpretation. Below 3% gives us excellent. 3% to 5% gives us good. 5% to 10% is a fair. 10% to 15% is high risk, while 15% and above is critical. This is not good. This is bad. Linda was comparing her results with that of her colleagues in other branches. Linda currently owes a 15.79%, which is on a critical level, while some of our colleagues had 3.24, which is way above 5% regulatory threshold. Our branch was in the critical zone. To make matters worse, she compared her performance with neighboring branches, all with 100 million portfolio as of that time. But the portfolio grew to outgrow what they currently hold. Branch A had 2 million in power loans, 2%, while Branch C had a staggering 20 million as against the portfolio they were carrying, 20%. Linda needed to act fast to avoid becoming like Branch C. A branch was having 2%, Linda's branch B. If it was going to do anything meaningful, it was to reduce their power so that they won't look like Branch C. To face the problem, Linda and her credit officer analyzed why their power was high. They discovered two main categories.
This is a textbook example of a bad portfolio. It lacks diversification and exposes us to risk. We must address these weak points immediately. Let's review the risk metrics together. We must strictly enforce our pre-disbursement controls. That means robust KYC and credit bureau checks. We cannot afford any lapses in our cash flow assessments. Let's review the applicant profiles now.
Internal and external causes, things they could control. Poor credit appraisal and inadequate documentation was one. Weak post-disbursement monitoring of borrowers was part of it. Delayed and poor recovery effort was also a big problem. They also looked at the external causes, the environmental factors, economic downturns and inflation, reducing customers' repayment capacity, natural disasters, or industry-specific challenges affecting local businesses. These were things they needed to look at. So they will need to look at how they're going to reduce the problem they had internally and the ones they could control externally. They put themselves to task. They called the customer, they did actual monitoring, they cut down low size that they were not supposed to do. They did a lot of things they were able to point out. Actually worked out well for them. The turnaround strategy. Linda implemented strict portfolio management strategies to rescue her branch. What did she do? She engaged in pre-disbursement control, enforced strong KYC procedures and credit bureau checks, which they were not doing before, mandated thorough cash flows and character assessment, which was a key in them determining how good or bad a loan could be. Then in the post-disbursement and collections, they instituted regular customer visits and early warning system. They set up automated SMS alert, reminder calls, and prompt recovery visits. They diversified the portfolio to avoid concentrating loans in one industry or geographical areas. One good thing she did, she also trained her team to watch for early warning signals above the theoretical aspect they read on papers, like frequent repayment delays that needed visits. They watch out for declining account turnover, business closure, or borrowers suddenly avoiding their loan officers. They engage them thoroughly to make sure that this was taken very, very seriously and not likely as they used to take it. Months later, Linda ran a new case study on her branch. Our total loan portfolio had grown to 200 million and our loan overdue 30 days were managed down to 18 million. Looking at the power above, we had 80 million over 200 million, which gave them a power of 9%. Our new power was 9%. While not perfect, she had moved from critical to fair, as well as on her way to meeting a Microfinance Bank ultimate key performance.
We did it! Look at these numbers! This is incredible! Great job, team! I'm so proud of everyone.
Over the next 2 months, our portfolio grew. Our PAR reduced drastically. And this was one thing that she had wished for. Our PAR currently holds at 1.5%. And it calls for a big celebration for our bank.